Merry Christmas, stackers. Yeah, I know I said it. I told you to kill the screens, ignore the spot, and just stack memories with the family. That was the goal. I really tried. Poured a drink, shut the rig down, and swore I wouldn't peek at the metals charts for the rest of the day. But I wouldn't be filming this update right now if the news hitting the wires wasn't absolutely critical. This isn't FUD. This isn't hype. This is a legitimate red alert. I need you to hold on a second. Put down the drink, step back from the news feeds. What I'm sharing didn't come from Reddit or a forum thread. It came from verified vault data out of the East, and it signals something way more critical than a standard price tamp down. The Shanghai Silver Exchange just sent a signal we can't ignore. Not a prediction, not a cup and handle. Math. Hard, brutal math. The kind that reveals the deep structural cracks before the dam fails. Here's the figure that matters, $80. That is the true cost of physical bullion in Shanghai right now. Not paper contracts, not COMEX games, real bars being settled in the biggest factory economy. Now open your local spot price app. Low 70s. That spread shouldn't be there at all. In a sound market, it wouldn't. If silver was truly cheaper in New York, banks would drain the vaults, ship it east, and lock in risk-free gains. That mechanism is called arbitrage. It's the gravity that keeps global spot prices aligned. And when gravity fails, something deep inside is broken. Why disturb the peace? Because tomorrow the U.S. market opens into Ghost Week, the lowest volume trading days of the year. And right now, a massive arbitrage vacuum is dragging prices to reality. Markets hate vacuums. They fill them quickly, and they usually fill them with extreme volatility. What comes next shows why this spread exists, why it's widening, and why ignoring it could be a massive error you can't reverse. If you're still stacking type 1 in the chat, so I know you see the squeeze coming, let's slow down and clear the air because skepticism is good for stackers. Whenever a premium like this hits, the first reaction is doubt. People assume it's a glitch, a Forex error, or a unit mix-up. So instead of asking for blind trust, we're going to crunch the numbers together step by step using the official exchange data. The rate I'm tracking comes from the Shanghai Futures Exchange front-month silver contract. This isn't hearsay, it's the settlement price for industrial buyers who actually stand for delivery. That contract closed before the break at 18,145 yuan per kilogram. That figure alone doesn't mean much until you convert it correctly, which is where most folks get confused. First swap yuan to dollars using the live Forex rate. That puts the price at roughly $2,500 per kilogram. Next turn kilograms into troy ounces since real silver isn't weighed in standard ounces. There are 32.15 troy ounces in a kilogram. Divide it. The result lands just above $80 per ounce. No gimmicks, no speculation, just the math. Now check the COMEX price, 71. 72 if you're lucky. That difference isn't a spread you trade, it's a red flag. In the bullion business, a gap like this means one thing: the rig that is supposed to keep prices honest is finally breaking down. Because here's the law that holds until it snaps. If shiny is cheaper in one spot and pricier in another, money flows. Metal moves. Gains are harvested. That process kills the gap. When the spread doesn't close, it means the physical trade cannot be executed. And that leaves just two options. Either the bullion in the West can't be sourced in bulk, or it can't be shipped at all. Both cases point to the same truth paper spot prices, and physical reality have completely decoupled. This is where most traders make their fatal error. They assume the paper chart is real, and the physical price is the glitch. History proves otherwise, when the two-split paper always corrects last, and it never happens peacefully. In the next section, we'll answer the big question why China is willing to pay the premium and why they are doing it right now. Now, we hit the core of what most folks are missing, because premiums like this don't just happen. China isn't paying $80 for silver for a quick flip. They are paying it because holding fiat has become far more dangerous than overpaying. If this was a speculative bubble, the buyers would be clear. Hedge funds chasing candles, retail apes piling into stonks. That isn't what the data shows. The volume spike on the Shanghai Exchange is from commercial hedging accounts. Simply put, it's coming from the factories. This isn't a paper squeeze, it's an industrial panic. When banks panic, they want cash. When industry panics, they want raw metal. If they don't get it, lines, stop contracts bust, and the company starts bleeding fast. In that scenario, spot price becomes irrelevant. physical availability becomes everything. Solar manufacturing is the primary squeeze point. China controls the vast majority of world solar panel output. For years, suits claimed silver needs would fall as tech reduced usage per panel. That process has hit its physical wall. Industry data confirms silver use per watt is no longer falling. The chemistry can't be pushed any further without killing efficiency. Simultaneously, plants are upgrading to high-efficiency tech that guzzles significantly more silver per unit. Usage is up while mine yields are tapping out. That's why industry is skipping dealers and standing for delivery directly on the exchange. Investment-grade bullion is being melted just to keep the assembly lines alive. But solar alone doesn't explain the rush. Electric vehicles are the second shock. Next-gen battery tech drastically boosts silver usage per EV. Chinese makers see this coming years out. They aren't reacting to news. They are securing stacks before the bottleneck becomes visible. When industry decides supply risk outweighs price risk, markets don't move slowly. They snap. Next, we'll look at what this behavior is doing to stockpiles and why the word shortage isn't strong enough for what's unfolding. To grasp how serious this has become, you must stop looking at spot and start looking at physical inventory. Price reflects sentiment. Inventory reflects reality. And right now, the stockpile data out of China is screaming danger. Check the warehouse stocks tied to the Shanghai exchange. Just a few years back, those vaults held massive stacks of bars. That metal acted as a buffer, a shock absorber for demand spikes. Today, that stack is gone. Visible inventories have been drained, and the metal available for immediate delivery is nearing zero. This is where the market flashes its truest signal: backwardation. In a normal market, futures are higher than spot. You get paid to wait because storage and loans cost money. Backwardation flips that logic. It means buyers will pay more for metal today than for delivery next month. In simple terms, they don't trust the vaults. Right now in China, buyers are saying, "Don't promise me silver later. I don't believe you. I need it in hand." That isn't speculation. That is fear of a default. This is what a real shortage looks like. Not empty pages on a dealer site, but factories refusing future contracts. They are voting with capital draining metal from the system as fast as it appears. Once backwardation hits this scale, it rarely ends quietly. Contrast that with the West. Traders in New York are staring at charts, the DXY and resistance lines. They're trading silver like it's a forex pair. China is treating silver like a strategic asset. Those two views can't coexist for long. Every ounce that leaves the vault tightens the noose. Less metal means less liquidity. Less liquidity means small buys move prices violently. This is how calm markets turn volatile without warning. This brings us to the ugliest question of all. If there's a clear arbitrage profit sitting in front of every bullion bank on earth, why isn't anyone taking it? That question is the key to everything that follows. Right now, every veteran trader is asking the same question. If there is a clean, visible profit between the COMEX and Shanghai, why aren't the biggest banks on earth taking it? Wall Street exists to close these gaps. Banks use algos to scalp fractions of a cent. A multi-dollar spread should be irresistible. And yet the spread is blowing out. That tells you everything you need to know. If silver was truly available in the West, the ARB would be done. Banks would be buying contracts, taking delivery loading bars on planes and selling into Shanghai. It would be free yield. The fact it isn't happening means the metal can't be sourced in bulk or it can't be moved at all. This is where paper theory hits physical reality. Paper contracts swap instantly. Physical metal won't. You must locate, insure, haul, and deliver. Right now, that chain is failing hard. We see reports from logistics and vaulting lines that should never be stressed simultaneously. Refiners are backed up weeks. Vaults need days to find bars. That reality alone should make your skin crawl, folks. In modern vault systems, every bar must be accounted for instantly. When a vault needs time to find your stack, it implies the metal isn't sitting where the paper claims. At best, it's rehypothecated. At worst, it has been promised to multiple owners at once. This is why the RB trade failed. Bullion banks aren't ignoring the gap. They are trapped by it. Every bid to close the spread reveals the physical inventory backing the paper scam is dangerously thin. This brings us to where things stop being theoretical. While traders argue online, something real is occurring inside Western vaults now. Metal is draining, not gradually, not quietly. It is being yanked out in massive size. In the next chapter, we're going to look at the hard inventory numbers confirming this drain is underway and why it changes the risk profile of the entire market overnight. Now we move from theory to proof, as the story stops being a warning and becomes a record of fact. While the herd was distracted by holidays, Western exchanges quietly dropped latest inventory data. Buried inside those figures is confirmation that something is breaking. Watch registered inventory not eligible. Eligible stacks belong to anyone and may not be for sale. Registered is different. That's the metal warranted and available for delivery. It's the lifeblood of COMEX. Without it, contracts are just paper promises with no anchor. In one trading day, a major refining vault saw over 1 million ounces exit registered. Other vaults followed with huge withdrawals. This wasn't retail buying junk silver. This wasn't investors playing around. This was institutional-grade metal being stripped from the system. That is exactly what a run looks like in a tight commodities market. When registered drain is this fast, it creates a feedback loop. The less silver left, the harder for banks to manage delivery risk. The harder delivery gets, the less willing they are to short paper. And with less paper, the more violently price reacts to demand. This is why the arbitrage gap keeps growing instead of closing. The demand pushing Shanghai higher is draining Western vaults. Every ounce removed makes the next harder to find. The whole market begins feeding on itself. This is where confidence dies. Futures markets only work if participants believe delivery is possible. Once that faith cracks, behavior shifts instantly. Buyers stop trusting paper promises. Sellers stall. Liquidity vanishes. And that is the brutal backdrop for what happens next. Because tomorrow the U.S. market reopens into the thinnest liquidity window of the year. Skeleton crews, thin books, algos running wild without restraint, a market already hollowed out facing a price signal it can no longer ignore. In the next chapter, we walk through exactly how this setup turns a price discrepancy into a sudden, violent repricing and why timing matters more than most stackers realize today. This is where structure meets timing and why the next move rarely gives a second chance. Markets don't crash when all are watching. They break when eyes are off and liquidity is thin. That is exactly the zone we are entering. The days between Christmas and New Year are ghost week for a reason. Senior traders are gone. Risk desks understaffed, order books shallow. Normally that means quiet trading, but there's nothing normal about a market carrying a multi-dollar disconnect from physical reality. When liquidity vanishes, price stops moving in steps and starts moving in parabolic jumps. Here's how it happens. A single whale, maybe industrial places, an order to hedge production. They aren't speculating, they aren't timing, they just need coverage. In a liquid market, that order is absorbed. In Ghost Week, it hits an empty room. There are no offers at the last price. So the order climbs the book, hitting higher levels just to fill. What should be a small move becomes a gap. Algos see that gap and react instantly. They don't get context. They only see market imbalance. Now the feedback loop starts. Rising spot triggers algo buying, options hedging forces banks to chase the move to manage risk. Each forced buy pushes price higher, triggering the next round. This is how markets detach from history in hours, not months. The key point is this. None of these players are irrational. They are responding to a structure lacking the metal to dampen volatility. Once that structure fails, price becomes the only release valve. This is why watching headlines misleads you. The explanation always comes after the move, never before. By the time the story makes sense to the herd, the repricing has already happened. In the next chapter, we address the single most dangerous mistake stackers make in moments like this, assuming the first big move is the end rather than the beginning. This is the pice trap that catches even seasoned stackers. When spot finally moves, when silver hits 70 or touches 80, the instinct is to sigh with relief and assume it's over. Crisis resolved, bubble popped, time to sell. That instinct is dead wrong. Violent moves do not end structural problems, they expose them. When a market reprices this fast, it isn't finding equilibrium, it's hunting for it. The first surge is where denial breaks. After that, behavior changes, and behavior drives the next market phase. For decades, industry ran on just-in-time supply. You didn't stack metal, you trusted the market. You assumed if you needed silver, you could buy it. A $9 premium destroys that trust. It tells every manager the same thing: silver availability is no longer guaranteed. Once trust breaks, the hoarding begins. Here, price elasticity dies. If you're building a 50 grand EV, the difference between $70 and $90 silver is irrelevant. What matters is if the car can be built. Logic applies to solar electronics infrastructure. Silver is a small cost, but very critical. This is why $80 isn't a ceiling. It's a line in the sand. Once crossed, it reframes the talk. Execs stop asking, "Is this expensive?" and start asking, "How much do we need and how fast can we actually secure it?" Meanwhile, Western investors are anchored to old numbers. 30 felt high, 50 felt extreme. That conditioning is dangerous in a regime change. Markets don't care what used to feel expensive. They care about clearing the supply. The real risk isn't volatility, it's hesitation. Waiting for a perfect tamp in a tight market means watching price move without you. By the time calm returns, the opportunity is gone. Next, we talk strategy, not hype, not panic, but how to think clearly when true price discovery replaces central bank price control schemes. When a market moves from manipulation to true price discovery, prediction ends and discipline rules. This is where most fail, not because they're wrong on direction, but because they're unprepared for the volatility. The first trap is anchoring to spot price. The number on the screen feels real, but in stressed markets it isn't. If silver is quoted at 80 yet can't be sourced there, the quote is just a reference, not a trade. Availability matters more than optics. A better compass is the gold to silver ratio. Historically, during supply stress, the ratio compresses aggressively. It doesn't drift. It snaps. Until that ratio normalizes, silver remains undervalued structurally, regardless of how uncomfortable spot price feels. The second trap is reacting to paper volatility. Thin liquidity creates tamps that look like reversals. Flash crashes shake confidence, not fundamentals. If physical premiums stay high, those dips are dislocations, not signals to sell your stack. This is where conviction is tested. A thesis built on demand, inventory depletion, and logistics failure doesn't change because spot swings $5 in an afternoon. Volatility is just the cost of admission, not a warning signal. Position sizing becomes critical. Too much exposure forces emotional calls. Too little creates FOMO. The goal is balance, allowing you to hold the stack through turbulence without panic or paralysis. Markets don't reward perfect timing during regime shifts. They reward conviction. Those who see the change early and stay disciplined are the ones who survive. Finally, we step back from the charts and talk about what this moment represents, the lessons it carries, and how to act with clarity as the next phase unfolds. Zoom out, stackers. This isn't just about the shiny metal anymore. We are seeing a total reset in how real value is found. For ages, spot price was rigged by paper derivatives detached from the physical stack. That scam ran on trust and fake infinite supply. Now both lies are finally shattering apart. When the physical metal dries up, power flees the paper game for pure hard necessity. Securing bullion matters more than analyzing rigged charts. The price is no longer a convenience. It is a screaming signal that massive stress has finally breached the suppression scheme. The market never announces the big break cleanly. It starts with confusion, then wild volatility. True discovery only hits after the repricing is done. The herd waits for confirmation, but that is always too late. Smart stackers aren't guessing. We understand the rigged structure before consensus forms today. The real lesson isn't about chasing candles. It is about respecting the physical shortage. When industry drains the limited supply, a price reset is inevitable. Old rules stop working and waiting to stack becomes costly. You don't need to time the bottom. You don't need to trade the paper swings. You need grit, patience, and the guts to hold through the tamps without panic. That is how we survive the reset. We do not ever game it. If this deep dive helped you see the real play, make sure you are subscribed so you don't miss what is coming. Share this with any normie still trusting the Fed, and let me know in the comments what you think this massive shift means for the metals market going forward right now. This isn't the end of the squeeze. It is the start of a whole new era.